down. The Fed cut rates for the first time in 9 months. Small cap beat large cap stocks for the first time in a while. Market cap has been a determinant recently of returns. Market valuations remain stretched in some areas, and now the market continues to chug along despite a number of concerns. We'll chat about that and more in today's quarterly context review. Welcome to this quarterly context review for the third quarter of 2025 for friends and clients of the advisory group. I'm Greg Patterson, CEO. For those not familiar with the advisory group, we're a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal and family realms, their fiduciary employee support efforts and retirement plans, and their communities through foundations and endowments. To complement the strategic work we do with clients, our quarterly context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to our personal wealth, endowment, and fiduciary clients stay more relaxed by being informed and therefore making better decisions towards your goals. We try to keep this to about 20 minutes, and we'll also circulate a link later should you like to share this with someone else that might be helped by it, or if there's a part of it you'd like to view again. So we'll cover a number of topics today. And as always, we like to remind everyone to focus on that space between things that matter and the things that you can control. You can't control whether or not the government shuts down and what the economic implications are of that, but you can control how you respond, how disciplined you are as an investor, how you make wise decisions about asset allocation and appropriateness relative to the timeframes of spending, and so forth. And always, clients come first. We are here on the same side of the table to provide the best, most unbiased advice we can. A number of news topics occur, of course, every quarter. This quarter, some of the highlights were after a lot of back and forth in terms of tariffs in Washington and elevated tariffs and trade war risks. The EU and Washington reached a deal which helped avoid a trade war. The market like to see that, although the overall concern remains elevated. The Fed did end up later cutting rates by a quarter point, and one or two rate cuts are still possible before the end of the year. Gold has been pushing to a new high. We'll talk about that in a moment later. And there was no deal at the end of the quarter to avoid a shutdown, and subsequently there has been a shutdown. In terms of some of the key metrics we like to show you each quarter, rates dropped a quarter point to 4.25% range. This is after 3 cuts in 2024 and 11 hikes between 2022 and 24. And the most recent cut was around unemployment as a primary concern, even though inflation risks remain high. Because cutting rates can increase the growth rate, but also trigger higher inflation, which can then be damaging to the economy, increase growth rate. So it's a fine line to walk. In terms of inflation, ticked up a little bit, which is a concern for the Fed, from 2.4 a few months back, but still far below the historically high level of 9%, really only beat by the period of the 1970s, where it was up into the 16-17% range at one point. Returns for the quarter, the S&P, or the large cap US market, was up 8%, so quite solid. That's higher than the full annualized projected return, so that's always helpful to see, but that level of strong ongoing market begs the question as to whether or not markets have some cooling on the horizon. Bonds also strong for the quarter. This is about an 8% annualized return, 2% for the quarter. And interestingly as well, after being lagging for a while, small company stocks were up 12%, so beat the large cap or S&P market by more than 4%. However, growth stocks continue to outperform value stocks, broadly speaking, and value stocks, some would say, are poised for a rebound, and the growth stocks may be poised for some level of cooling. However, that doesn't mean that will happen immediately. The unemployment numbers ticked up, as mentioned before, related to the Fed's decision to cut rates to 4.3 from 4.1, and overall U.S. growth rates ticked up to 3.9%, so solid, up from 3.1. The pre-revised number is later revised to this 3.9, and then that's up from the overall 2024 rate of 2.8. In terms of economic and market highlights, talked about the government shutdown. We'll jump into that a little bit more on the next slide. Talked about rates and how stocks have been strong. The small cap was led by technology primarily, and overall the strong stock market has been driven by relatively steady economic activity despite some of the concerns we'll talk about below in a moment. And one of the drivers has been enthusiasm or excitement around artificial intelligence, which has a lot of potential but not a lot of certainty in terms of specific timeframes and impacts and segments of the market that might benefit, and how that might also impact employment numbers, as well as the rate cut being a factor here in terms of stocks rallying. International stocks are continuing to be on a tear, up 26% year to date. This is after an extended period of international stocks being out of favor relative to the US. So those that have been disciplined, such as our clients, in retaining that are benefiting significantly, and proof that diversification does pay, although sometimes it requires patience. The dollar stabilized after dropping about 10% in the first half of 2025, and real assets, or assets that are generally considered to be inflation-fighting assets, were solid with the quarter, 16% annualized, but a lot lower than broader stocks. And we mentioned this because we had a dedicated real assets component added to the portfolio before we expected inflation to rise. Inflation did rise over a number of years, so this was not a tactical move as much as a long-term strategic move based on what the patterns are of inflation relative to very low rates and stimulus. And so it's, on a relative basis, paid off to remove it from the portfolio. And even this 4.1% may seem overstated because part of it's elevated by really strong gold numbers. Gold in the concern bucket here is up 45%, and gold is really a fear asset. When people are worried about stocks or the economy, or also in this case the dollar, people tend to pile money into what they perceive to be a safe haven. But in the very long run, gold doesn't even beat inflation. So when people say, should we invest in gold? Should they invest in gold? Some portfolio managers will include mining companies that might get from gold more indirectly, but given the long-term pattern, it's more of it underperforming stock markets and bond markets and not even beating inflation. Generally not a great long-term asset, even though it can give people some FOMO in the short run. But it did go above $4,000 per troy ounce for the first time recently, so is getting some attention. Overall, as mentioned, U.S. valuations are stretched. We'll talk more about that. There's elevated policy uncertainty in general in Washington, international relations, tax, economic, otherwise. And that includes trade tariff policy with 17% overall effective rate, the highest since 1935. And that's higher tariff rates back in the 1930s is what triggered the U.S. Great Depression, the worst economic downturn in the history of the country. So there's reason to be concerned about extended elevated tariff rates. Inflation remains elevated. Employment has picked up as well. We'll talk more about that. But about the government shutdown, primarily as usual, around spending priorities. The longest prior shutdown was 5 weeks. This was during the middle of 2018, Trump's first term. The implications include challenges for the Fed if they don't have data, because the government agencies that gather and produce the data are not functioning at the moment, and so that data is not available. So that makes it tricky to navigate and fine-tune and steer the economy when you don't have the data. This could impact growth rates in the US generally speaking as well, because if there's less government spending, some would celebrate that, and others will say, wait a minute, that could mean that we trigger a recession. So depends on how long, how impactful that is. And then in terms of financial markets, inflation-linked securities could be affected on the horizon. But if you look at this long-term chart here showing the different government shutdowns, most of them were 1 day, a couple were 3, 5 days. The second longest, 16 days, the longest as mentioned, 35 days. And while markets go up and down, there's no clear pattern of a shutdown creating a long-term downtrend. However, given the uncertainty and variability and tension in Washington, will it be different this time? Possibly, but hard to say. But hopefully this long-term data provides some confidence that it won't be the primary driving factor. We'll see how long it lasts and how deep it goes, and something to watch. Markets overall, solid as mentioned. Stock markets are strong, all positive. Bond markets were solid as well, with a 6% year-to-date return for the US bonds. International bonds a little bit weaker, but still positive. The primary negative returns were global real estate taking a little dip here. It looks like that arrow should be red and upside down. And the 5-year return for bonds in the US was negative, but this negative number has been shrinking in terms of negative status as the US market has been adding strong quarters. So people a few years back who said, wow, bonds are down, what do bonds do? Why can't we count on them in a difficult time? Well, when there's a big rate hike, that hurts bonds and the stock market, and so it didn't feel great at the time. But if you look at all these other numbers, the numbers are starting to rise and does provide cushion in most economic and market downturns. You can see here the overall pattern of the 4 worst markets and their recoveries. Stocks are relatively elevated currently and have had a few dips: global financial crisis, COVID, other dynamics, rates, and when it's this strong, this quickly, this high, it's never surprising when markets cool a little bit. That doesn't mean it's on the immediate horizon, but don't be surprised if there's some hiccups along the way. That's part of long-term investing. Stock valuations, some would say, many would say, are stretched in terms of price-earnings ratio as a measure. See this chart relative to long-term, at the highest level since the dot-com crash. Does that mean there's a big crash on the horizon? No. There was a lot of bad business models with no earnings back in 2000. A lot of really big, very profitable companies now. So markets and stock and companies are different, but that doesn't returns can head upwards endlessly. Compared to other countries and regions, the US is relatively elevated in valuations as well, with other countries hovering closer to a more normal range, although some are a little bit elevated in currently, but not nearly as much as the US. If we look at different ways to slice and dice the US market over different time periods, the broader pattern that we're noticing is that while large cap, for many reasons, driven by mega cap stocks, and their especially strong returns, the Magnificent Seven, some would call them, and some other stocks as well, have really driven the mega cap and large cap numbers up. But other segments are starting to catch up a little bit. So that's normal, and leadership is never permanently constant. Unemployment numbers, as mentioned, ticked up a little bit. This made the Fed concerned and led to a rate hike. Wage growth cooled off a little bit. So with unemployment going up and if wage growth is cooling, that generally equates to lower spending and more cautiousness and nervousness on behalf of investors. We'll show you a confidence slide in a moment, and that can lead to economic cooling. Inflation hovering around that 3% level. Oil has cooled down a little bit, but it's always a bumpy ride. Fed cut of 0.25% is creating kind of a gradually decreasing shift from the relatively near-term highs after the ratcheting up over a few years to try and rein in inflation. Other information about inflation projections are shown here with the Fed projections in blue showing a slower series of cuts than the market expectations here in green. The market is expecting cuts to happen sooner and then come back up faster. The yield curve is a prediction generally of the economic outlook from the bond market perspective. So we have 2023, we have other numbers that showing a significantly inverted yield curve. The short end is higher than the long end. More recently, the yield curve is starting to normalize, especially from the lowish, medium end out to the long end in terms of the length of the term of the bonds, but still inverted in the short end. So this implies uncertainty and concern about the short-term nature of the economy, with some increasing confidence about the longer term. Confidence, as mentioned, can be impacted by inflation, wage growth, rates, politics, other things, and overall confidence dropped down a little bit. We're now at one of the 3 or 4 lowest points in the last 50 years. It can lead consumers to spend less, which decreases GDP, which slows markets and stocks, and can inch us closer to a recession to the extent that that remains or becomes a risk. Some kind of recession is inevitable. Eventually, the question is, will it happen anytime soon? Quality is something we look at as an interesting perspective, in particular, also with bonds, but in this case, looking at stocks. You can see here when it shows red, it means lower quality, more speculative stocks are doing better right now, and that sometimes is a sign that there's more of a risk on or momentum element in the market returns, whereas if it shows green, it's more of a high quality beating lower quality stocks, and higher quality stocks tend to do better in downturns. Lower quality stocks tend to do better in hot returns and worse in difficult markets. So when stocks have been like this for a while, the more speculative, lower quality stocks, sometimes that reverses, and we might start seeing more green here in the future quarters. This tends to take turns naturally over time. But we actively diversify across both low quality and high quality stocks within portfolios through the different mutual funds or investment managers that we research and select for clients. And that helps. It's another layer of diversification. And as a reminder, whether you are an endowment or an individual or family, it's important to think about your money in terms of when you'll spend it, because time horizons should dictate the level of risk you take. And if you have money that's approaching a spending period, it can make sense to have it in a shorter term portfolio or some sort of shorter term design or exposure. And some of our endowment clients, for example, have money across a whole array of different buckets with very clear defined spending needs over specific timeframes, and that helps control risk and optimize return. Our private wealth division has interesting questions that we like to highlight here every once in a while. I think this is the first time we're doing it this way. And one thing we've been hearing recently is that our tax planning and tax strategy support has been helpful, and clients are realizing that while their CPAs are expert in tax and tax return and creation, not always as much of a focus on tax planning and strategy as they thought. So some of that work that our personal wealth group is doing is quite helpful. We don't produce tax returns. We work alongside tax accountants to help optimize the client's overall situation from a tax standpoint. We also get questions and recommendations around professional trustee services or compensation consultants. Questions that come up around asset allocation and what's appropriate. Sometimes when there's a concern about the stock market being down or the stock market being too hot, and this leads to discussions around timeframes and goals and risk and probability analysis, and sometimes will lead to an update of a financial planning analysis, although we do that proactively for clients who have that service as part of what we provide. We also have a new division that provides advice for people going through divorce. This can be very helpful, especially for people who do not have a lot of comfort around financial topics as it relates to these matters. So that provides a lot of peace of mind and to those individuals, and really helps people know how to end up okay. In terms of the advisory group in our organization, we've added a few people recently. We added an advisor and a support specialist. So total team of about 11 when we include our semi-internal or fractional specialists. We have people in several different states, and we also have an extended team of more than 20 people, some of whom include specialists in analytics and economic forecasting and asset allocation modeling at Callan, one of our research partners. That information then gets fed into our own internal client policy committee, and we have discussions with internally with our committee members and the specialists at Callan to help optimize that information as we utilize that internally to benefit our clients. We also have 7 operations people in a back office, and a regulatory specialist, accounting, bookkeeping, IT systems, communication support, including and also web programming for some of the designs that help our clients. We also have new blog posts, usually every month, at least several a quarter. One that may be helpful to a lot of you is the retirement plan fiduciary education video. I would highly recommend putting this on your checklist for any new fiduciary committee members. And we are working on a foundation endowment version that should come out in the coming months. So while we'll do a very quick review of part 2, I want to thank those of you who are viewing this now for attending. We hope this is helpful information. If you're a client, reach out if you have any questions that you'd like to go deeper on any of these topics. And if you're not a client or would like to explore becoming a client or how we might be able to help, whether it's personal wealth, endowments, or retirement plans, reach out to these contact points here, and we'd be delighted to discuss with you. So as a quick review, a couple of points. Anytime you'd like to go deeper, contact us and we can walk you through and remind you of the details of the 5-step process. There's also a 5-step personal wealth broader process that this investment process sits inside as well. There's research that can be helpful around investor behavior, both in terms of individuals as well as fiduciaries, institutional investors. Studies show that many are prone to make emotional mistakes, and that discipline really does pay off and leads to better returns in the long run when the process is good. We help clients think through how to optimize their short-term money, and we can discuss the business cycle. And retirement plan fiduciaries should be aware. We discuss this in meetings at least once a year, but if you missed that meeting, you can see here quickly, and feel free to reach out to us to discuss what the shape is of what we call the glide path if you have target date funds, or the nature of the stair-step type design of risk-based or target allocation funds, which are static and not dynamic. So the glide path measures that shape, and whether it's the custom funds that we build or off-the-shelf mutual funds that some clients use. You can also access the projected returns for the next 10 years based on the most recent information. If you have any questions, feel free to reach out. And thank you very much for joining us today.